Barry on the weekend, so $1.50 for fuel. It's going to be a bit of an expensive trip. So, luckily, I've put a little bit of money aside. Now, over the last couple of months, we've been learning about how to become masters of our financial world. And so our financial guru, our money master, the Wake Up WA money mentor, Matt Hern's been talking to us about the 3 C's. Now, we learnt about how to keep an eye on and maintain our cash flow. Last week we spoke about the second C being contingency plans, so things that could possibly go wrong, kids popping up and so forth. To find out what's the third C, and a little bit of a tricky question to get out the way in a G rating. Good morning, Matt Hern from FINDRA.
Morning, Jason, and morning, Anita.
Good morning.
Kids popping up can be a pleasant thing, as I've experienced recently. If you plan for it, that's the whole important thing about it.
They shouldn't just pop up.
No, that's exactly right.
Have a bit of warning on that one.
Absolutely.
But today we're going to be talking about the third C of money mastery. So what are we talking about today, Matt?
So the third C, and as we mentioned, cash flow and contingency, the third C is cracking the whip over your wealth. And what this is all about is that you work really, really hard to earn your income and then to save a little bit of it as surplus income. Make sure that when you do save a little bit of surplus, it's working just as hard for you as you worked to save it in the first place. That's what it's about. And today we're going to cover 3 of the high priority behaviours within cracking the whip over your wealth. And they are earning high interest on that savings that you've put in your cash account, then sorting out your superannuation, which is wealth you've already got, and the third one is investing more aggressively.
Right, so out of those 3 high priorities, which is the first one which we're going to crack the whip over this morning?
Well, the first one really is the cash in your bank account, because when you do first save some surplus, it usually goes into your bank account or into maybe a separate bank account. And most bank accounts languish at, 0.5% interest every year, which is nothing. It's chicken feed, and basically you're supporting the bank, not yourself. So the first thing is to earn high interest on that cash savings that you've made, so that it's working really, really hard for you and accumulating more. And once it's accumulated more in cash, then you can start looking at working it harder in even more aggressive investments.
Now, obviously, you're not going to recommend going into high risk areas to start off with your cash savings, but where's a good way to get a bit more interest than what you get from the standard bank account?
Well, the best way is really to, even within the banks, the big banks and any other institution that offers a standard bank account, they usually have higher interest accounts that maybe have restrictions like you can only access them online. And so there's a lot of high interest online bank accounts at the moment that link to your existing account, but they earn you, 6 to 7% interest per annum.
Yeah, I was just going to ask, I don't know if you can say, but what is considered a good interest rate? Because, I wouldn't know.
Well, look at whatever the Reserve Bank of Australia's cash rate is, which at the moment it's between 6 and 7%, and if you can get around 0.5% below that, that's really good, or even 1% below that is really good. Anything really higher than 1% is a lot better, because that's what you're doing if it's languishing in your normal transaction account. So anything higher than your normal transaction account is good. But at the moment, the best is around 6% to 7%.
6 to 7%?
Yeah.
So shop around, get the best interest rate, makes perfect sense. Now, one of the other areas that you mentioned, which I've just realised how badly in neglect my situation is superannuation. How can we focus on superannuation to maximise our money growth?
Well, I'm glad that you talked about superannuation, and it's probably the one that most of us do ignore. There's a lot of perceptions about it being boring and you're never going to get access to it, but we know we're going to get access to it. And the thing is, even if you're spending all that you earn, but if you're working, you're still having superannuation paid by your employer into your account. That's wealth that you one day will have access to, so there's no point in letting it languish. You may as well make sure that as possible there in that account. So the ways to do that is, first, make sure that all of your accounts are maybe into 1 or 2 at the maximum. Sometimes there's a reason to have more than 1, because you're paying minimum fees on all these accounts and you're losing track of them, you're missing out. Why not consolidate them, get the benefit of the economy of scale, bulk purchasing effectively, and do it? That's the very first one. The second one within your superannuation is that many people don't even bother about the investments within the account. They just look at the account and throw it in the rubbish bin. But really choose the investments within the superannuation fund to be more appropriate to your circumstances, because it may be in a really low risk account or even a medium risk account. And for young people, we've got 20 or 30 years till we can access our super. We can afford to be more aggressive than conservative or balanced type funds. Because we've got time on our side.
So even within your super, you can take a bit of a punt knowing that it'll level itself back out again at some point.
Well, see, I wouldn't call it taking a punt. It's called educated, looking at educated risk, really, because you're looking at, I've got 20 years on our side, which really leads us into the third thing that you can do as well.
So this is obviously, so your third point. So first of all, manage your cash you've got. make sure your super's working for you as best as it can be. So highest interest rates, best investment portfolio. And so then the third thing we're going into then is
investing more aggressively. Now, at the moment, when you look at the last 6 months, perhaps, of say, the Australian share market turmoil, where it's dropped 10, 20%, many people would think, well, I can't even contemplate that. But yesterday, there was some research released, which is released every year by the Australian Stock Exchange and Russell Investment Management, looking at all the different investment classes over 10 and 20-year returns to see how it's gone. And really, when it comes to creating wealth, it's a long-term game, not a short-term game. And with a long-term analysis that ASX and Russell did, over 20 years, the Australian shares performed better than any other asset class, which might surprise those who love residential investment property, which was included in the study. So if you love investment property, don't exclude Australian shares because it does perform really, really well. And the other thing is...
Even at the moment with such a dive?
Well, see, at the moment, it doesn't matter.
Doesn't exist,
Wealth
really.
creation is a long-term game. It's a long-term game. Short-term fluctuations are really a blip on the radar when you're thinking about long-term wealth creation.
Right.
And that's
I've got
the
some
really
friends
thing
who I hope are
think
watching
about.
this morning who read the stocks every single day and they, I made $17,000 today and I lost 120 grand yesterday.
Yeah.
They're living in this constant world of sort of excited fear.
And to me, that's an absolute waste of energy. Money is to facilitate life. And if creating that money leaves you in a state of constant fear or stress, there's no point doing it. So the key thing about investing more aggressively is we know that the wealthiest people, they do that. But the way to manage your fear around that is to get educated. And that's why investing more aggressively is the behaviour. But if you don't feel comfortable doing that, start learning more about what the true risk is.
What does it really
Educate yourself to
mean?
manage
What does investing aggressively actually mean? I mean, so what you're saying is sort of go for something that might represent a little bit more risk but better return. Is that what you mean, or?
Yes, absolutely. Well, that's perhaps the simplistic way. Risk and return is maybe the higher risk, the higher return you get, but that's not truly the case when you get to more sophisticated type stuff. Really what it means is risk is considered in that context as what happens in the short term. So does it fluctuate like a roller coaster in the short term? And are you rewarded in the long term? Because if you look at a 20-year snapshot, does it really go up a lot more? So really what investing more aggressively means, get on a roller coaster that's a little bit of a hairier ride in the short term, because in the long term you'll be rewarded for being able to hack the ride, basically. That's what it's about. You get a greater thrill in the long run because you look at your bank balance and it's a lot larger.
But to invest aggressively, do you need a lot of money to start with?
No, you don't.
No?
You don't, absolutely, because you're investing more aggressively in a sense by using a higher interest bank account.
Right.
In a sense. It's just little simple behaviours like that. And no, you don't need any money that you've got. You can choose where it goes, whether it's conservative in a bank account or more aggressively. So how much you start with doesn't matter what sort of investment you go with, generally speaking.
Generally.
Yeah.
And I think a lot of people would be interested to find that Australian shares have performed better than residential retail over that long-term snapshot. Because but your recommendation will be to diversify a little bit, so you don't put all your eggs in one basket.
Absolutely, diversification is really the key for one way of managing risk over the long term and education. Because and it really depends upon what your goals are, but spreading over multiple Australian shares, some investment property means that it evens out the short term. So in the long term, you still get a similar result, but it evens out the short term. And that's one way to manage your fear factor around investing more aggressively.
And I think a very important thing that you've mentioned again today, I should be ashamed of myself for not getting onto it earlier, get all your superannuation into the one or possibly two if there's a good reason to have two accounts. Because I think I worked out about 2 days ago I've lost about $7,500 by having multiple accounts and paying fees on all those. So then a couple of them actually gone down to zero.
And that's a really good point because you've lost $7,500. So how much would have you been prepared to pay an expert to sort that out? And that's the key thing. Most people won't be prepared to pay an expert to sort it out, but you lose a lot in those extra costs. So just hand it over to an expert, sort it out and make the money in the future.
Matt, I'm going to have to get you around every Friday.
Yep.
But that's Matt Hern from FINDRA, our money master. So learning more about how we can look after. So the 3 C's. So this is the 3rd C today, cracking a whip over your investment, earn high interest, make your super work for you, and be a little bit more aggressive in your long-term investment strategies. Matt Hern, thank you once again.
It's always a pleasure for you.
Yes, it always a bit eye-opening and always makes me feel a little bit more ashamed of myself each time you come in. But not ashamed, but motivated to go and do what I should have been doing all along. Good.